Welcome everyone to this webinar on Unigestion's macro views. I'm Salman Beg, a portfolio manager on the Cross Asset Solutions team. My colleague Ken Ebeling isn't able to join us today, but I am here with our head of macro research, Flora Nielpo.
Hi Salman, hi everyone.
Now, before we start, I just want to quickly run through some logistics. We'll walk you through a handful of slides during which you can ask questions you may have by submitting them in writing via the text box on your screen. We'll take some time at the end to answer some of your questions, but if we don't get to your questions today, we'll follow up afterward. And if you have additional questions following the webinar, please reach out to your sales contact and we'll get back to you. With that said, risky markets have continued moving up last month, albeit with a pause in consolidation as we saw concerns grow about the increase in new coronavirus cases, especially in the US. That sensitivity could be interpreted as investors being too optimistic on the recovery. And I think one of the questions on many people's minds is to what extent a recovery is priced in, given that many equity markets are close to their pre-crisis peak. So Florian, maybe we can start with discussing how the cross-asset team sees market pricing today. Are investors optimistic on the path ahead?
Yeah, sure. And maybe we should go directly to page 2 of the presentation, which basically sets the scene regarding the question you just raised. One of the key questions, and I mean that's currently heavily debated, of course, in the team is to what extent has recovery been priced already in financial markets? As you can see on this chart, you can see the rebased evolution of our growth basket. So it's a basket of assets that helps us measure how much growth are currently market pricing. And you can see the very striking elements on this chart, which is we've reached back levels last seen in October 2019. So the temptation of saying, well, basically the recovery is here, but it's been priced, it's behind us, is large. We disagree with that idea, and why is that? We think that what you can see here is merely the pricing of the systemic risk that emerged from the COVID-19 crisis, and its disappearance is basically linked to what's on page 3 of the presentation. Let's go to page 3 of the presentation. We've talked across the past webinars about the significance of the role of central banks mitigating the liquidity risk, the default risk, the systemic risk, and that is still with us. This time we wanted to focus on what's not exactly new, but what could make a difference within the coming months. And that's basically the push made by many governments deploying a fiscal stimulus that is represented on this page, on page 3. And as you can see, there are 2 key takeaways from that. What you can read from this chart is the money promised by many governments to face the current challenges of this crisis with a comparison with what we had during the GFC in 2008. First key takeaway, if you just focus on the red bars, you can clearly see that the comparison is what's been promised this time is twice as much what had been promised during the GFC. It's large. Now there is also heterogeneity across countries. As you can see, Germany and the US are standing out. They're offering in direct stimulation 10% of their GDP. It's unprecedented, and this will also play a significant role in our view in mitigating this left tail risk that I was discussing just previously. So basically, we think that markets are currently discounting that the left tail risk is not as big as what it was, and the reason for that is because central banks have been intervening and governments have been promising a lot of money on the table to mitigate the economic consequences of the crisis. And it shows in the data. If you'd like to go on page 4, you can clearly see that most macro data are currently pointing to a recovery. And this recovery has 2 unique features. The chart that you can see in front of you is our world growth forecaster. So it's a synthetic point-in-time indicator that helps measure where do we stand now in terms of economic growth. Okay, above zero, growth above potential, and below zero, growth below potential. Okay, this first black line mainly says that we are currently witnessing the fastest recovery ever. You see 2 months past the bottom. You see the small white dot shows where we are past 2 months past the bottom across the past 4 recessions, and you can clearly see that currently is the fastest recovery we've ever seen. First feature. Second feature is when you just focus on the bar charts with the 4 red bars highlighting the diffusion index, so the percentage of economic data improving across the thousands of data we're looking at and the 83% of the world GDP we are monitoring through that indicator. Basically, we have currently 75% of improving data. 75% of improving data. So it's a very broad recovery. It's not the broadest recovery. 08 was broader to some extent, but currently it's the second broadest recovery we've seen so far. Okay, so in our view, there are limited doubts regarding the fact that the recovery is there very clearly, and it should have started to get more and more investors to believing into it, right, Salman?
Yeah, in a way, I think we really see sentiment as being split. If we go to the next slide, we can talk about a couple of different perspectives on this question. How much is the market reflecting this recovery? So the left chart is one approach to assess expectations. Here we're looking at equity analyst earnings estimates for the firms that they cover. What we're simply doing is aggregating up the end of year earnings numbers for last year, for the current year, 2020, and for next year. We do this for a handful of equity indices, S&P, Eurostoxx, etc. And we can see is that by and large, analysts do see a strong recovery by the end of next year, meaning by the end of 2021, analysts are expecting firms to for the most part, recoup their 2020 losses. Now, Europe and UK look less positive, but broadly speaking, we're seeing recovery elsewhere. In EM in particular, we're seeing analysts expecting earnings to actually surpass the 2019 levels. If we then focus on the chart on the right, this is our market stress nowcaster, which assesses and aggregates different types of market pricing of investor sentiment. And as the chart clearly shows, this indicator in red is back to neutral territories, meaning when we look at the liquidity in markets, the implied and realized volatilities, funding spreads, the underlying components of this indicator, markets don't seem to be too much at risk. That's not to say that the risk is non-existent. We're not at the low levels we saw in 2019, but we're no longer at the elevated level that we saw earlier in the year. These are a couple of key reasons why we think the market has priced out the left tail risk, the type of risk where firms default, spreads widen at the same time that investors look to deleverage and liquidity subsequently dries up. Forward-looking estimates of corporate earnings aren't expected to collapse, but rather rise strongly. And financial market stress, which is particularly sensitive to this left tail risk, is no longer high.
But does that translate into a more optimistic view on an ongoing economic recovery?
Yeah, so I think that's the critical point here, that despite investors seeming to be less worried about a left tail risk, their views on a broader economic recovery haven't improved much. If we go to the next slide, we can see that from one perspective, their positioning. Now, obviously, we can't look at the literal line items different types of investors hold around the world, at least not at a useful frequency. But what we can do and what we've developed here is a picture for their positioning by triangulating across some different perspectives. So what we've shown here is a couple of these perspectives. The chart on the left shows the realized beta of different types of hedge fund strategies to equities here, MSCI World. The key takeaway here is that they remain lowly exposed to equities at the end of June. Equity long short funds remain below their long-term exposure, so they've delevered and have essentially stayed there, while macro hedge funds and CTAs seem to be modestly short equities at this point. If these investors were expecting an economic recovery that would boost equity markets, we'd expect their positioning to be much more positive. Another useful perspective is provided by the chart on the right. So this chart takes net flows into equity mutual funds and ETFs and accumulates them since the beginning of last year. So here what we're essentially getting at is a proxy for the equity positioning of retail investors who are large holders of these products, right? So the chart on the left is really about hedge funds, sort of, fast money investors, if you want to think about it. The chart on the right are your retail holders, real money, and their exposure. And what we can see from the chart on the right is that outflows have continued to surpass inflows for most of the recent period. There were some net inflows in early June, but retail investors seem to haven't meaningfully reloaded on equities despite markets moving up, indicating to us that they're still cautious on a growth recovery. This is one of the key reasons why we think the recovery doesn't seem to be reflected in investors' portfolios. That obviously begs the question, well, what about market pricing? Is it reflected there? Maybe Florian, you can take that up.
Yeah, it's a very good question from our perspective. If you don't see a trace in the recovery in many investors' portfolio, it's hard also to find a trace of that actually in the valuation when you dissect the valuation of risk premia. We've looked at that question from three angles. Angle number one, the bond market perspective. Number two, the multi-asset perspective, the cross-sectional evolution of risk premia. And the third element, a pure equity perspective. So let's start by putting ourselves in the shoes of the fixed income investor and go on page 7. One of the most obvious way of looking at the pricing of a recovery in fixed income markets boils down to looking at real rates. What you have in front of you is the US real rate, that is to say the difference between the nominal and the break-even rate in the US, so real rates. And as you can see, currently, real rates in the US are first negative and two on a downward trend. This is at odds with what we've witnessed from 2016 to 2017 during a recovery period. As you can see, from 2016 to 2017, upward trend, and that ended up in positive territories. So currently, if you look straightly at the bond market, the overall average opinion of the market is we're not witnessing a recovery. The second angle goes down to be looking at the cross-section of risk premia. And if you'd like to go on page 8, you will see something that we've showed in the past, which is our cross-asset valuation indicator. Just as a reminder, this cross-asset valuation indicator is an average between two different measures, a time series valuation and a cross-sectional valuation. The time series enters the question, if I take duration, if I take rates, bonds, are they expensive compared to their own history, time series valuation? Cross-sectional will mean, let's take all risk premia at one given date point in time, and then let's try to compare them and see which of them is the most expensive and which of them is the least expensive, the cheapest. What you can see on page 8, what you would expect actually on page 8, in the case of a recovery, would be expensive growth assets and cheap hedging assets, meaning duration, inflation break-evens, energy, industrial, and gold. And we have currently exactly the opposite. Many growth assets remain in the cheap territory. They are not as cheap as what they were a couple months ago, but still they are in the cheap territory. And what's expensive right now actually is duration, inflation break-even, energy, and industrial metals. that also is not a symptom of a pricing of a strong recovery. So the fixed income market doesn't price it. From the cross asset perspective, it's hard also to find a good trace of it. Now, if we turn to the last of our angles, on page 9, you can see the slice and dicing of the performance of the MSCI world since the beginning of the year. So first perspective, fixed income; second perspective, multi-asset; third perspective will be equities. We've put together this model, which is a Gordon and Shapiro type of model that makes it possible to slice and dice the performance of equities based on 3 factors: earnings growth, short-term rates, and long-term rates. What you see in front of you is a model decomposition of what has been happening since the beginning of the year. We've opened the year around 2300, and with the 20% earnings shocks, we could have been expecting minus 700 points down on this index. The decline in short-term rates shouldn't change much to this picture, but the decline in longer-term rates, orchestrated by central banks, must have explained about as much as the 20% decline in earnings. And that is our key argument. Basically, with lower rates, with the action of central banks, this has offset a large portion of this earnings shock coming from the lockdowns. Now, if we add, and that's the portion on the right of the chart, if we add on top of that an earnings recovery, then there is room for upside. And if we see just, which is our scenario, a normalization of earnings, meaning earnings go back to where they were in December 2019, between 2020 and 2021, we could see an upside, a further upside to the equity market that could be of about 15%. Again, the timing this upside is likely to be difficult, but at least we see a valuation upside on the equity market as this earnings recovery is not priced yet. What is priced for the moment is the decline in longer-term rates.
Thank you. Thanks for that, Florian. If we go to the next slide, I think this is a useful one to synthesize our key views. Now, Florian and myself as well, we've stepped you through what we're seeing in terms of sort of 3 key factors that we look at: macro sentiment and valuation. Again, from a macro perspective, we're seeing a positive picture there with growth recovering. We're seeing the green shoots of a recovery. Sentiment, as I mentioned before, we assess as being somewhat split, where the investors have priced out that left tail risk, but are not pricing in a recovery. And valuation still remains supportive for growth-oriented assets, a bit less supportive than it was a month ago, let's say, but still supportive for growth assets, which remain less expensive, certainly compared to hedging assets. What this means in terms of our views is, not significant changes from last time if you've been following along. So we remain bullish on growth-oriented assets, especially equities broadly. We're retaining a preference for what we call quality growth equities. These are equities where they've got good growth metrics, but then also when we look at their balance sheets, when we look at how much cash they have, the stability of their earnings, et cetera, those sort of classic quality measures, they rank highly on those as well. This is implemented via long positions or overweight positions in NASDAQ and SMI in particular. We believe these firms also will benefit from secular and cyclical tailwinds and would suffer less if there is a further shock and we see equities fall. So those are really our key views here. And while we wait for some questions to come in, Florian, maybe you can discuss the risks to this view.
Yeah, sure. From our perspective, there are two key risks to our positioning. The first one is another round of lockdown due to a severe wave 2 of COVID-19. We are not arguing against the potentiality of a second wave. We just doubt the world would enter again into a large lockdown period if a wave 2 happens. We think that governments are now better equipped, better prepared. We also travel less, which will limit the spreading of the disease. And economically, we must say also that we can't see how we could afford it. Again, given the large stimulus put in place for the first lockdown, the second lockdown would be the second wave of lockdown would have to be matched by a similar effort. I mean, that's hard to anticipate. So in our view, the country's likely answer to wave two implies much more efficiency than what we've seen in H1 this year. So that's the first risk. We don't see that risk as being very likely. The second risk, from our perspective, is more a macro risk, the risk of a natural W scenario. In spite of the pace of the recovery, in spite of the stimulus, we have currently higher unemployment, very high actually, unemployment rates, high saving rates, much lower capacity utilization rate. So there are many evidence that the economic situation is not well. There is a risk that the economic situation would slow again after the current recovery period. That would be the essence of a W type of recovery. From our perspective, given our positioning, we don't believe in this scenario either, for two main reasons. The first one is, as we've described it, the path of the recovery is faster than usual, and this should drive a faster economic normalization than we've seen in the past. That's a key element to our investment policy, to our positioning, the pace at which we're seeing a recovery in the data, in the hard data. The second element that makes us doubt that we would see a W scenario is the fact that we've discussed a lot monetary policy. Monetary policy is here to hedge liquidity and market risk, because that's the primary role actually of a central bank. The fiscal stimulation aims precisely at quickening the path of the recovery. That's the essence of it. So the stimulus we're currently seeing unleashed is unprecedented in terms of scale and also in terms of the number of countries doing it in the meantime, which is an essential element to the efficiency, if you want, of fiscal policy. So we expect from that actually potential positive macro surprises, given the still tepid expectations across economists. When we look at economic forecasts for the time being, we see also a bit of bearishness on the macro front, even among central bankers and world organizations. So we think that we could be surprised to the upside by the macro evolution, given that we've never seen such large-scale Keynesian policy put in place across such a large number of countries. Now, well, actually, we have a question on now on the U.S. elections, which are getting closer. That could be actually listed as a third risk. Simon, tell me, how do you see the event, and how do you think about getting prepared ahead of it?
Yeah, so we think the U.S. elections, it's an important risk that isn't quite yet at the forefront of investors' minds. That I think the news has picked up on that a bit over the last couple of weeks, but it's still not, I think, quite on investors' minds. President Trump's chances for re-election have gone from essentially, in our view, 50-50 a few months ago to much worse today, due mostly to his administration's response to the coronavirus and his handling of the protests around the country. Importantly, though, we think the key question is less about the potential of a Democratic president, but rather whether Democrats can take the Senate. Again, a few months ago, it was more of a long shot in our view, but now it seems closer to a toss-up, to a 50-50 chance. And this, to us, is the main risk, a Democratic sweep where they hold both the House of Representatives, the Senate, along with the presidency, right? That would give them the willingness and importantly, the ability to implement many of the policies that Biden has campaigned on, in particular, rolling back corporate tax cuts and pushing forward on healthcare reform. Now, it's important to note that a Biden presidency, it's not all negative for markets. A softening of trade rhetoric, and I think we'd likely see a more, let's say, diplomatic stance on domestic and foreign policy should help to lower uncertainty. And of course, with that lower uncertainty, we'd expect to see lower equity vol, risk premiums to contract, and markets to benefit from that. But in our minds, those are impacts that we would see further down the line once Biden actually comes into office, and we see how he reacts to issues like China and trade with China, et cetera. But that all to say that we think that that's further down the line, and in the shorter term, that the market will focus on, in particular, the corporate tax implications first. So that's where we see some risk. Now, in terms of positioning for this, in terms of preparing for it, there's a couple of options. Downside protection using optional structures, for example, is one path, but it won't be cheap. VIX futures are already elevated going into the election as well as afterwards, likely due to the delays that one would expect, given the results will likely be delayed due to mail-in ballots, etc. So there's we think a better case to be made for allocating away from those sectors or specific firms that are most sensitive to tax reform. Essentially, you could look at the winners from the 2018 tax overhaul and use them as a set of firms or sectors you might want to move away from. There's also the case of investing out of U.S. equities more broadly, but that's, we think, less clear, given that there still remains significant positives for U.S. equities that will continue to hold under a Biden presidency. So while we've been talking, we've had another question come in. Carry strategies this year are showing disappointing results. How do you position yourself there? Florian, maybe you can take that one.
Yeah, with pleasure. So our way of answering this kind of question is always by replacing it within our framework, replacing the performance of risk premia within our macro sentiment valuation framework. From the back of my mind, over the 1990-2019 period, bond carry, DMFX carry are strategies that usually profit from economic recovery after having suffered during economic downturns. For now, we've seen the first leg of that, crystallized a pattern, but not the second one, meaning the negative performance this year and not the upside in these carry strategies. And June and July make no exception. In June and July, the performance of carry strategies looks unusually low. So first, the current, say, sanitary and economic situation is specific. The recession has mostly been technical to some extent, and the recovery is potentially of the same kind. Now, with what we believe in is that with the stimulation put in place by central banks, the growth recovery and the apparent inflation normalization that should be following these two factors, we see in many alternative risk premia a catch-up potential. Carry strategies for one, but also selected equity factors such as value, for example, could beneficiate for investors' favor for a time. From our perspective, the carry theme looks appealing for the medium to longer run, especially on the back of monetary stimulation, fiscal stimulation, recovery. The recovery theme should beneficiate to some extent also to the value factor, to the equity value factor, for instance, but we see that more as a temporary element. And as Salman explained, we should expect quality growth stocks to keep on being outperformer within equities, not value for the longer run. So we for the a dynamic technical allocation. So carry strategies, they've been lagging, like many risk premia to some extent, but we know that ballooning central bank balance sheet is usually an excellent trigger for risk premia to start contracting, as you said, Simon.
Great. Well, it looks like we are out of time. I want to thank you, Florian, for sharing your insights with us. And I'd like to thank you, the audience, for your attention and engagement. If you have further questions about what we covered today or our insights or strategies more broadly, feel free to reach out to your sales contact. Thank you again, and be safe.
Bye. Thanks.